Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday Market Update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. This week on Tuesday because of the closure yesterday, but stocks to watch, economic trends you need to see, and I am excited for the elections this year. I think probably said no one ever. I think the only ones getting excited about elections anymore are the advertisers and the news media. But what about the stock market? How do stocks generally do during a presidential election year? Can you trade on it, or is it just kind of a bunch of noise that you should probably just ignore? I'm going to detail the facts around that, how to invest in stocks during an election year. Stick around after that. We'll do our stock market update, all the stocks I'm watching this week, and the economic news you need to see. Before that, though, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in those major multi-year themes, with one of the picks up 100%, and the group up an average 94% last year alone. That report is totally free. You'll see that first stock immediately, and then they'll send you an email with the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks, so look for that link in the description below. Back to our main topic though, and Nation, I try not to get dramatic here on the channel, but sometimes I just need to grab your attention, if nothing else to give you the facts before someone else steers you in the wrong direction. This time every 4 years, investors are flooded with analysis about how to trade the upcoming election. I wanted to give you the facts before you run into another source with an ulterior motive, usually trying to get you to trade in and out of your stocks. That's because stocks have actually done pretty well during election years, just not as well as some others. In all 18 election years since 1950, the S&P 500 has averaged 7.3%, which is under the 9.3% average return in those non-election years. Now, this all comes with a huge disclaimer, though, that I'm going to reveal later. The upside, though, is that volatility, or the stock market ups and downs, seems to be lower in an election year. Election year volatility was just 14% versus that 17.7% otherwise over the period. So while the return is a little bit lower on average, you also don't have to sit through quite as many sleepless nights worrying about your stocks, and that is worth something. Now, in that same theme though, stocks over the last 7 decades were up 83% of the time during an election year, more than 4 out of 5 years. That's better than the non-election years, which saw stocks only up 68% of those years. So again, a smoother ride for investors. One more piece of data, and I'll get to the question that everybody's asking, but analysis by PFG does show that stocks tend to do better in presidential election years versus the midterms. Now that's good for 2024, but still doesn't overcome the average return in those non-election years. What I thought was even more interesting, though, in data back to 1950 was that the third year, so the year before the presidential election, was by far the best for returns. In the year after midterms, but before the presidential, we've seen stocks higher by 17% on average. And that might be the big takeaway here. The direction of stocks in election years is kind of up for debate, but what we usually see in midterms is a more divided Washington. And typically voters sour on whoever won the White House in the 2 years before, and the opposite party does really well in those midterm elections for Congress. That tends to tie up government as both sides just bicker back and forth and gets it out of the way of businesses and investors that just want those stellar returns in the third year of the cycle. Now, if the stock market this year looks like it typically does on a monthly return averages during the presidential year, that 7.3% annual return is going to put the S&P 500 around 5118 by the end of the year. Now, that is an all-time high, but not much from where it is now or that 4,800 peak we reached 2 years ago. Now, I don't get political here on the channel, and I'm only including this Republican versus Democrat elected data because I know there's going to be comments and questions. Also, though, because it displays a very important disclaimer in these stock returns on election years. Research by First Trust breaks down the presidential election years by who won, a Democrat or a Republican, and it shows that back to 1928, the market was up 15% in years when Republicans won versus 7.6% in years when the Democrat was elected. Wait just a minute here. Before the Republicans get giddy or the Democrats click away hating me, I think the data here is skewed big time, and you should take it with a huge grain of salt. Now, sure, you could reason that the Republican Party typically running on that platform of lower corporate taxes and less regulation would be good for stock returns. Investors might think that businesses are going to have free rein over the next 4 years. That would mean a boon to corporate earnings. But if you look at the years here, it quickly becomes obvious that some of these returns are throwing off the averages, and it might not be all it seems. For example, that giant 37% dump the market took when President Obama was elected in 2008 couldn't have been his fault. The financial crisis developed over the Bush years and peaked before the election. In fact, after bottoming in March, the stock market posted a 21% return for 2009 and went on to produce an 11.6% annualized return during Obama's 8 years through 2016. Similarly, the 9% loss on stocks in the first year of the Bush W administration was just the fallout from the internet bubble during the Clinton years. There are other outliers here as well, including the losses during Roosevelt's Depression years. In fact, if you remove the negative years from each party, then that gap narrows to almost nothing, with an average annualized return of 17.7% return in those Republican-elected years versus 16.3% in the years a Democrat is elected. So nation, when it comes down to it, this is probably just kind of a nothing burger. It's probably something you don't need to worry about or change how you invest. The data is inconclusive at best, and there are better ways to spend the time you research, like following those interest rate cycles and how falling rates this year are going to continue to boost stocks. I just wanted to show it here because a lot of investors are asking about it, and I know all those spamming investing news sites are going to be making a mountain out of this molehill and trying to get your investing dollars. Don't be fooled by that shiny object distracting you and that real stock market analysis. I want to take a look at some of the stocks I'm watching this week. First up here, gold miners have done nothing for years, despite the price of gold hovering right around its all-time high since November. The VanEck Gold Miners ETF, that ticker GDX, is no higher than it was 4 years ago. Here we see the all-in sustaining costs for some of the gold miners here, that price they need to break even, the margin and valuation multiples. We do know that inflation and persistently high fuel costs for transportation have weighed on that profitability. And those AISC for gold miners rises past $1,300 an ounce on average last year, but this should still leave room for healthy margins of profits. The upside is that those expectations for most miners are very good over the next year, and fundamentals have improved. We can see here some of the all-in sustaining costs fairly high for some of the larger ones like Anglo Gold, Ashanti up at $1,600, IM Gold at $1,500, but you've got some of the other ones, Newmont at just $1,376 in all-in sustaining costs. That leaves a healthy margin for Newmont, the largest miner there. You've got Barrick, Kinross, some of these other popular ones, Goldfields, Agnico Eagle Mines is making 40% profit margin on their gold. For example, if we go here to the analysis tab on Yahoo Finance, we see Newmont Corporation, ticker NEM, is forecasted to book revenue growth of 52% and to see earnings grow from $2.16 a share to $3.17 over the next year. That would put the shares at just 1.86 times expected revenue, a 47% discount to the average 3.6 times multiple on revenue over the last 5 years. This company has paid down debt for some of those monstrous acquisitions over the last few years. It's paying a 4.3% dividend while you wait for the shares to head higher. Also watching some of those Bitcoin ETFs that got approved last week. Here we have the Bitwise Bitcoin ETF, the ticker BITB. Now with the approval of 11 Bitcoin ETFs last week, we saw a wave of alternatives for investors interested in investing in crypto. Now, I've held on to the Grayscale Bitcoin Trust, that GBTC, in the past, but sold when Bitcoin touched 47,000 last week. And why I wanted to bring this up for you is if I do buy back in, it's not going to be into that GBTC, which charges a 1.5% management fee, but the BITB, which is charging just 0.2%, the lowest among these approved funds. Understand, folks, that none of these ETFs is doing anything but buying and holding Bitcoin and then selling shares to that pool of investors. That means there's no reason to hold a fund with a higher expense fee, as these funds are all going to return pretty much the same pre-fees. Until we get some kind of actively managed ETFs or ones using option strategies come out, just go with the least expensive fund. Also watching WW International, ticker WW. The old Weight Watchers there has fallen 25% since Eli Lilly, ticker LLY, announced it would open up a direct delivery into its weight loss drug program. Shares are already come down as investors worried here that WW rollout of its own weight loss drug programs were not progressing as well as it hoped. I still like and hold the shares here, though. I think they're getting close to the point where the stock traded before the program announcement last year. I think the company does very well, even against that drug maker's direct program, really on its just holistic and membership-oriented approach. Subscribers look to be turning higher in the third quarter report last year, and fourth quarter results on February 6th could come representing a turning point. Giving you that big picture idea here with the sectorspiders.com sector tracker here, great free resource on the internet. We did see that 7 of the 11 stock sectors closed higher last week with really little rhyme or reason as on the performance. Growth sectors like technology and communication services bounced back on investor optimism, while stocks in the energy sector fell on the continued weakness in crude prices. Now, investors rushed out of their stocks and utility sectors without any real earnings or news catalyst, which kind of leads me to believe that the sector can rebound in the weeks to come. One trend I am following, if we go here to the 6-month period, we can see that stocks in the financial sector, especially the regional banks, have outperformed over the last 6 months, though the crisis last March has the group lagging over the last year. The recent outperformance could continue, though, as the banks come into the first quarter, second quarter earnings season, which is going to present very easy year-over-year comparables. Regional banks are going to be able to show that how they've put the last year's crisis behind them, and valuations could continue to rise on those historical averages. More importantly, over the next month, though, Wall Street and company management seem overly pessimistic. Wall Street analysts surveyed by FactSet we see here have lowered their expectations for fourth quarter earnings by 6.8% over the month before the reporting to forecasting just 1.3% profit growth across S&P 500 companies. Here we see the historical changes each quarter in those analysts' expectations. While analysts typically do lower their expectations throughout the quarter, maybe just to make it easier for the companies to beat when they do hit those forecasted earnings, it's been a much milder 3.5% on average over the last 5 years here. That's against an economy that is still doing relatively well. Low unemployment and wage growth is really keeping consumer spending. On the management side, management at large companies seems to have been bitten by this same negative bug. Of the 111 companies that have previewed fourth quarter earnings, 72 of them have issued negative profit warnings, well above the 10-year average of only 60 warnings ahead of earnings. Of course, part of this is all a game that analysts and companies play to manage those expectations and to make management look better for beating those forecasts, but it all strikes me as overly pessimistic given the economy and a chance for companies to surprise investors as earnings come out over the next few weeks. Look for the link in the description below, get your free report, and see the top 5 stocks in my portfolio. My 5 forever stocks up on average 94% in the last year alone. Or click on the video to the right to see how to invest $1,000 in 2024. The 7 stocks in 3 different portfolios I'm watching. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.